All right. Well, guys,
All right,
I'm going to step out for just a couple minutes, and then I'll let you guys take over. I'll see you in about 3 minutes with Danielle DiMartino Booth.
Yeah, she's already on from what I see. Blake, perfect. Dale?
Yes. Yeah, hi, Steve.
Hi.
So,
Yes,
there's Danielle. I've had the pleasure of interviewing Danielle once before on Face. Great to see you back, Danielle.
Hi there.
Yeah, and I'm really looking forward to this interview that you have with Blake. And gosh, what a period that we're looking for. When I talked to you, I couldn't have imagined what we have happening here in our world. We've really crossed into a new paradigm, haven't we?
We have. It's just more of the old paradigm.
Okay, right. On steroids?
Absolutely. Yes.
Okay. All right. So I'm going to save the questions for Blake, but I want to thank you for being part of our summit. And I'm a fan, and it's great to have people that don't hedge. When they have something to say, you say it, and you mean it, and it's with conviction. So looking forward to your interview with Blake Morrow.
Thank you.
thank you for being with us. Blake is going to be here in a minute.
Great.
Dale, it's not a crime. You can ask a question.
Oh, no, not a crime? All right. All right. Is Paul out of bullets, Danielle?
Powell's out of bullets for the moment.
Okay.
He's out of bullets for the moment.
Yeah, because he's really trying to jawbone having some fiscal action take place to support what the Fed is doing. And looks like they're finally going to come up with some kind of compromise. Do you think that they'll be able to put something together before the election, a relief package?
It's hard to say. I had an interview I had a keynote in Switzerland a little while ago, so I have not followed the headlines. Have they come up with a deal?
They're talking about a compromise now.
Oh, so the Democrats are no longer at the 2.4 trillion.
They're talking compromise. I'm not sure what it's going to be, but Blake is here, and it's great to see you, Danielle, and I'm looking forward to hearing your interview with one of the best traders I know, Blake Morrow.
Well, thank you, Dale. And hello, Danielle.
Hello, how are you?
I'm doing great. You know I got to tell you something that's it's kind of funny. I knew we were going to be matching today.
Yeah.
One of our traders who is in our he's in our community, and actually had a question for you a little bit later that I might spring on you. He's like I'm watching Danielle right now online doing this event, and he's like, oh wow, she booked some pretty close, and I'm like, oh wow, look, we're going to be matching today.
Yes, that was in Switzerland. That was actually a charitable event. They were raising money for Lebanon.
Oh, that's awesome. That's awesome. Well, first of all, I want to thank you for being part of the Traders Summit. We really appreciate you being here to kick off the event. And I couldn't think of a better person to have here. And I've seen you on TV multiple times. And I'm a little upset that I hadn't followed you on Twitter sooner. But you know what I was going to do is I was going to send you a succulent so we could do a between the two ferns like you did with Jeffrey. I was like, hey, can you hold up the succulent and we could be between two ferns? I thought that was a great interview, by the way. I'm a big Jeffrey Gumlach fan. Yeah.
I'm delighted that they follow my work as closely as they do. But that was my first flight post-COVID, was out to Los Angeles, and I walked into the studio and I went, you gotta be kidding me. This is way too cliche. I'm looking at these two plans and I'm like, oh, here we are.
When you said that, I was watching the interview in a car at my son's soccer practice, and I about fell out of my chair. Anyway. But once again, I want to thank you. I know the time's limited here, and to have you here is I think extremely valuable to the trading community. We are a community of traders and investors, so we might have a little bit different approach to your opinions than maybe some other groups, because we're always looking for insights, and to have somebody who's been on the inside of the Fed, I think is extremely valuable. So I wanted to really start off to asking you how you got your start at the Dallas Fed.
Well, so I'll make a long story short. I always knew that I wanted to become a writer, and I'm actually now a writer. We publish every day and every week. So after the market closed, when I lived in New York, I was at DLJ at the time before it got bought out by Credit Suisse. I would run up to Columbia, and I got my second master's in journalism as a night student when I was working full-time on Wall Street. So when 9/11 happened and the buildings came down, I'm long distance dating this guy back and forth from Dallas to New York, which was an adventure, but it was getting old. And so I sold my book of business back to the Drexel boys. I was mostly into trading junk at that point, signed a non-compete, agreed to leave the industry, and moved to Dallas, told the publisher of the Dallas Morning News that I would work for free. He said that worked really well with his budget. And within a few months, I've got my own column about the markets. I'm writing about mortgage equity withdrawal. I'm good friends with Jan Hatzius at Goldman Sachs, and I'm predicting that the housing market's going to crash. I was the only person on public record who said that it would be global and systemic in nature. And it was, because we know that the subprime bomb went off in something called a Landesbank in Germany that I'd never heard of. That's systemic risk. It's when risk pops up and you're like, what's that? So you don't know where it's going to occur. Anyways, about 12 months in or so, Warren E. Buffett reached out, and I'm like, spam. But I opened it anyways because I'm like, I wonder what E stands for. It actually was from Warren E. Buffett himself. He's like, I really like what you write. Come on out to Omaha. And I'm like, well, I've got a 5-month-old. And he's like, we can do baby press passes. Just bring him. So I did. And so I went out to Omaha. I met Charlie Munger, who had a great influence on how I think about investing. And 6 months later or so, Richard Fisher came calling. And wow. he's like, you should be working at the Wall Street Journal. You should be working at The Economist. You're wasting your life away. And I'm like, or I'm barefoot and pregnant and I've signed a non-compete. I've left Wall Street and I'm really happy. So in any event, he asked me to serve the country. I ended up doing so for 9 years throughout the financial crisis. He had a very unorthodox position for me. All Federal Reserve districts are bound to take their markets intelligence from the New York markets desk. It's written down. Okay. It reads like sell-side research. And Richard and I both had our MBAs in finance. Richard and I both started off on Wall Street in New York, and we knew the value of sell-side research, ... So he started his own markets desk inside the Dallas Fed. So wow. Before every FOMC meeting, I would travel to New York and I'd hit the trading desks and I'd speak to the economist. I'd talk to people on the buy side, go to Alliance Bernstein, check in with everybody and prepare a markets briefing. And that markets briefing, he would take into the FOMC meetings. Geithner and Dudley subsequently could not stand me because I'm speaking to the same people that their markets desk are speaking to, but I'm coming up with completely different conclusions that actually have to do with reality on planet Earth as opposed to the sell side research that they put out. Thank you, Mr. Former Goldman Sachs. And I got underneath their skin. But I'm proud to say that Powell used to read my research. And when I left the Fed, the minute that Richard walked out the door, I walked out the door. I am not a good bureaucrat. I don't do sensitivity training. I don't do any of that stuff. When he left, I left. We ran into each other at a football game. And he said, listen, Danielle, there's one person on the committee, only one person on the committee who I want for you to pay attention to. This is fall 2015. And I said, who's that? And he said, Jay Powell. He said, remember, he's Republican. Obama got him in with Jeremy Stein, who was a Democrat. Sometimes if you want to get one candidate in, you bring two in, you do the kumbaya thing as opposed to, hand-to-hand combat, which is what Trump has done with his Fed nominees in the Senate. So I said, fine, I'll pay attention to this Jay Powell person. He's the only person who wants to shrink the balance sheet. He's the only person who wants to normalize interest rates. So follow him closely. And I'm like, he's quiet as a mouse. He doesn't say anything. He's like, that's the point, Danielle. Less is more. Follow him. And then years later, there he was, Fed chair. So that's my short story long. Sorry.
Wow, no, that's an amazing story because I was gonna ask, what was your experience like? But it sounds like you were an outsider insider.
I was not liked at the Fed. I asked for a live CNBC feed, and they're like, what? And I'm like, the market's open, people. And these PhDs would go to the executive dining room like at 11 o'clock and come back at 1 and regurgitate their dissertation. And I'm like, and you'll wonder what's wrong with monetary policy. Look at you people. So no, I was not popular. I'm not on any Christmas card list at the Fed. None.
That's funny, but it's awesome to hear. And, you know, I lived actually in Dallas for 13 years, from 99 to 2012, before we moved back to Scottsdale, Arizona, to raise our kids around the family. You know, technology has allowed traders to kind of do that around town. You know, and I love Dallas, by the way. So, but I wanted to ask you, what do you think was your biggest takeaway from working at the Fed? Because it sounds like to me, you know, that it's hard for everybody to get things done.
It was. Productivity was something that they wrote about in theory, but that they had no understanding of in practice. They were the least productive people. You know, I'm like a poster child for Ritalin. They tried to give me the first generation of it when I was like 3.5. I'm clinically hyperactive, OCD, ADHD, all those things. Never taken any of that stuff, which explains me. But it takes a lot to slow me down to write a book. We publish daily. We publish for institutional investors every day. And I'm really good at news flow. I'm really bad at spending 2.5 years of my life writing a book that had to be footnoted. But that's how angry I got in 2010 when, at the conclusion of a year-long study, the Fed said, you know what? This inflation metric, it's led us down the wrong path, not once, but twice, and it needs to be replaced. And I'm like, you think so? You think asset inflation is meaningful? Okay, just so we're on the same page here. And after a lot of introspection and soul searching, they decided to do absolutely nothing about it. So they kept it. So
Really?
Stanley Fischer's first FOMC meeting when he was vice chair, raised his hand, stood up and said, why don't you use headline CPI like the rest of the world? And then, you know, and why don't you incorporate asset? Anyways, so some Fed staffer raised his hand, this is in the book, raised his hand and said, sir, if we didn't use the core PC, our models will break. And so Jim Bullard, in one of his only humorous moments, as opposed to yesterday, we're going to be out of this by the end of the year. But Jim Bullard raises his hand and he said, let me get this straight. This is how we make monetary policy. Crap in, crap out. And that's how they do it to this day.
Wow. And so hence came the book, Fed Up.
Yes. Hence came the book, Fed Up.
And, you know, you said something interesting about Jay Powell when you were telling us about how you kind of got to where you're at. And I wanted to ask, because I think he was on the right path, or he was on the path that you had talked about. Right. He wanted to normalize policy. He wanted to raise interest rates. He was almost there, and then COVID happened. So
no, you're wrong. No. I promise I'll make this really quick. Remember, his first day in office, the Dow Jones was like down over 1,000 points. His first day in office, February the 5th, 2018, Volmageddon was erupting. And he said nothing. His first congressional testimony, he said, not my job to backstop the stock market. Not my job. Thank you, look elsewhere. Halloween, GE's credit gets downgraded. 14 days later, junk bond issuance freezes for 41 record days. And the IMF and the BIS and they're like, excuse me, we've got a spread problem here. And we've got massive redemptions coming out of these exchange traded high yield funds, and the collateral backing them is trading by appointment only. And Jay Powell had to back off. So on January the 4th, he's up on stage with Bernanke and Yellen. He stands up in front of me. I mean, I was getting condolence cards in the mail. I'm crying, I'm bawling. And he's like, I'm sorry, when I was a rookie in 2012. I apologize for criticizing QE. It works.
Wow. And
that was the Powell pivot. And he never looked back since. Never looked back since, neither have markets. So COVID was just a bump in the road. COVID was like the catalyst, but what set off the leverage bomb occurred on Halloween 2018 when GE's debt got downgraded and was trading like junk overnight. And then they're like, oh God, we've doubled leverage in the space of a decade, and it's problematic. And that's where we are today.
You know what I love about you, Danielle, is you really understand the markets and behavior of the markets, not just the Fed and their actions. You understand how it really impacts the markets. And
so does Jay Powell, by the way.
I'm sorry?
So does Jay Powell.
Hence he's quiet.
He was in private equity. He founded the Industrials Group at the Carlyle. He's worth over $100 million. He thinks he's serving his country, and he speaks to all these guys, hedge fund manager. He understands the credit markets.
So when you talk about like taking a step back about COVID, since it's just a bump, so you say, how do you think their response has been to the COVID situation and all these loan facilities that they've created, all these acronyms that I forgot them all already? And do you think they're going to even do more moving forward, or can they?
This is now. It was clear that a doomsday policy was in place after what happened with junk bond issuance freezing.
Okay.
Neiman Marcus in May of 2019, Neiman Marcus issued some debt, and the bond market froze for 7 days. And Powell actually started making rumblings about negative interest rates and the possibility thereof, and then markets corrected themselves again. So the Fed had in place the doomsday scenario. So what was deployed with purpose and design. And we knew going into 2020, because Gunlack and I, we asked Morgan Stanley to redo some math that they had done earlier on in the year that said 39% of BBB rated bonds would be junk if the credit rating agencies were doing their job. So Morgan Stanley redid the math for us in December, and that 39% had gone up to 42%. Wow. So going into the year, Powell knew that BBB was an accident waiting to happen. So that's why you had the very explicit grandfathering in from March the 22nd on of any fallen angels. Any debt that had been downgraded was eligible for Fed purchases.
Wow.
So it negated the Ford effect. It negated all of the downgrade effect, because investors, even though they knew it was junk, had to treat it like investment grade because the Fed backstopped it explicitly in this special purpose vehicle. And that is what stopped the bloodletting. Go into the zero bound, unlimited QE, blah, blah, blah. All that was just, that was already planned and ready to go. The problem today is the market's beginning to lose confidence. Jay Powell cannot print jobs. Jay Powell cannot print cash flow. These are two things he can't do. He cannot stop the bankruptcies from happening because he can't print cash flow. So, and he does not like Donald Trump at all. Remember, he's a card-carrying Republican. Most people would not describe Donald Trump as a card-carrying Republican since he signed socialism into law. So you have to appreciate that he will not buy stocks with 39 days until an election. Because you can tell some Joe walking down Fifth Avenue that the Fed is buying junk bonds, and their eyeballs are going to roll into the back of their head, and they'll be like, huh? You know, junk bonds, more expensive than stocks. It's riskier than equities, for God's sake. He's gone further than the Swiss. And they'll be like, huh? You stop the same Joe or Jane on Fifth Avenue, and you're like, the Fed's buying the stock market. That's un-American. They can't do that. That's a big no-no. So it's optically and narratively, it's a lot easier to explain and a lot more damning. So if markets fall out of bed before election day, I don't think that the Fed comes in and buys stock, even though the fine print of the BlackRock agreement already stipulates that the special purpose vehicle is standing ready. Public matter. So what does Jay Powell do?
Does he do? He does nothing.
He's not going to do negative interest rates. The whole banking system would collapse. You can't do negative interest rates. Other countries can do negative interest rates, but your discount models, your Black-Scholes models, they plug in our positive interest rates so their models work. But somebody has to have a reference risk-free rate.
I was listening to Fed Chairman Powell yesterday and some of the comments that he said yesterday, and he said downside risk could well be out there without further aid. And it sounds like the Fed is begging Congress to do something at this point.
Well, they know that they're worried about the efficacy of QE, but they still know that it's got an 82% correlation with the growth of the S&P. The growth of the Fed's balance sheet has an 82% correlation with the S&P 500 since 2009. That is the only thing that they know that works in their tool shed to try and hold the market together. Is So if the Treasury has to issue a bunch more debt, then they're like, awesome, we'll buy it. So they're begging for stimulus.
Wow.
They need product.
So last week, Fed Chairman Powell said that he said, quote, "I wouldn't say we're out of ammo, but what if he said we are out of ammo, or we have?"
He did say it, didn't he?
Yeah.
I wouldn't say. I mean, but that's Freud channeling himself right through Powell's mouth. But they need product. They need paper.
I see. It's real. I was going to ask you actually a little bit later. I was going to ask you if you think that the Fed is influenced by the president, and I think I got my answer from you. What do you think?
No, in fact, I think the one thing that grates on him the most, and these are the whack jobs on my Twitter feed in the middle of the night who are like, he's just a crazy Trumpian, and I'm like, no, he's not. He's not. He's afraid of the credit markets. And he could give a flip about trying to support Donald Trump. So it is the biggest misconception on Wall Street is that he's doing something. Now, I will say, though, the caveat is Mnuchin and Powell speak the same language. So what the Fed is doing is against the law. And I think that future generations of politicians, we forget that in World War II, when there was yield curve control and they capped the 10-year yield, that in 1951, they had to cut the Federal Reserve and the Treasury had to be severed. The Monetary Treasury Policy Accord of 1951 by William McChesney Martin, who said, you've got to take the punch bowl away just when the party's getting started. He went on to become the longest serving Fed chair in history after he helped that accord push through. But future politicians are going to have to re-separate the Treasury from the Fed because the 1913 Act dictates that it be apolitical and independent.
I see. Well, can I ask you this? Going back to like the Fed and what they have in their toolbox, I've always believed, and you hear the Fed talk about it's mostly rhetoric, right? The rhetoric, in my opinion, is going to be Fed Chairman Powell's one of his biggest tools that he's got in his toolbox, right? I mean, we look at, like, I remember the Greenspan days, and you look at the briefcase indicator. Right, the old briefcase indicator. You're like, oh my God, he's holding so much papers. I think he just filled his.
Oh, he's on the record on 60 Minutes saying he liked to jack with investors.
Right. So, but what happens? Because you kind of alluded to it. What happens if the investing public loses confidence in the Federal Reserve? And are we already starting to see some of that right now?
You are, right? Because he blows it in Jackson Hole, August the 27th.
Yeah.
We're going to do this. We're going to do average inflation. And the whole world is like, oh, it's a regime change at the Fed. And I'm like, it's a bunch of bullshit. So, and then they come out the next week, a few days later with the FOMC statement, and all the way out to 2023, they see the PCA targeted at 1.7%. So the market went, wait a minute. And behind closed doors, and investors chased them behind closed doors. The Fed had started, before this rhetoric, before this major shift change, the Fed had been hoovering up tips, like buying all the Treasury inflation protected securities it could. And the market's like, oh, negative real yields, and the dollar is going to hell in a handbasket. And the crazies are out in the middle of the night on my Twitter feed going, the reserve currency status is going away tomorrow. Buy gold, Bitcoin now. And but the Fed is actually buying tips. The Fed is creating the narrative and this idea that inflation is bubbling up while you've got 26 million people yesterday collecting unemployment benefits in the country, which is deflationary. This is economics 101. And that's his biggest problem, is that he's trying to talk inflation up when it's deflation knocking on the door.
Well, and again, we go back to the rhetoric, right? And I was going to ask you, because from what I've seen of you, I already assumed that you were more seeing deflation near term, which I agree with. And I'm 100% in agreement with what you're saying.
Rent's coming down a third. Housing is the biggest input into every inflation metric. And you're seeing rents come down. They've got to be shaking in their shoes at the Fed.
So, okay, the Fed, and you kind of talked a little bit about this too. the Fed, tell me how they gauge inflation. And I know it's not right. I mean, as just, just a consumer, we see the inflation, we know it's there. The Fed doesn't see it, but are they hiding behind that? I mean, how?
It is, again, remember, why I spent 2.5 years writing a book, because they have to hide behind it. They know that our health insurance inflation is not Medicare and Medicaid reimbursement rates. They know that. They know we're spending a lot more on healthcare insurance, and yet they keep it in there. They know we're spending more on housing, and yet it's also understated, the two biggest line items in a household budget. And they net out oil and food. So, but they have to have the broken metric, because they have to hide something to hide behind in order to justify the constant QE.
So then I guess my next question would be, would they ever change it? But in based on what you're saying, they shouldn't, or they won't.
They can't. They're trapped.
So
they're trapped. I mean, look at how glacially slow quantitative tightening was, and the market just loses its mind. They can't turn the facilities off. They can't stop the printing presses. They can't even flirt with exiting. And what they don't appreciate is that they're going to get the inflation. They are. If they decide to become Uncle Sam's printing press for hire and put MMT into policy and directly monetize the debt, guess what? We're going to have stagflation. You're going to watch bond investors say, this is what I think about your treasury, and I'm going to demand more. If you're going to take it from $30 to $60 trillion, if you think you can get away with that, you're going to have to pay up. Without the growth, you go from deflation to stagflation.
Wow. That would be something, because we look at our bond markets, they don't move. They're completely stagnant. And I'm waiting for what is the breaking point that's going to really push yields one direction or the other, really. And right. That's as a trader, that's what we're all waiting for. And you make a great point. I mean, as a consumer, you live in Dallas. I live in Scottsdale, Arizona, probably two very hot real estate markets.
Yeah.
And I don't understand. As consumers, we don't understand.
Jay Powell has created the housing boom. It's his baby, because housing is the most leading of all sectors. So what does he do? He buys up $1 trillion of mortgage-backed securities in 5 minutes. And you've got a 30-year quoted at 1.99%. And you've got FHA lending. I've got a Bloomberg column out on the terminal today. It's on the web, but I walked through the math with a guy by the name of Ed Pinto at AEI, who was Fannie's former chief economist, and he walked me through the math. Americans have taken $100 billion out of their homes in 6 months. Cash out refinancing is white hot right now. And you've got Fannie and Freddie both using automated appraisals to do these cash out refinancings. They're not even looking at the house. So the Fed is engineering this narrative that there's this great pocket of strength in the market, because you've got this exodus from the suburbs. That's organic, fundamental, and real. Yeah. You've got wealthy people who are renting homes in the Hamptons for $75,000 a month in the winter. So that part is real. People of means really are buying in the suburbs. Vail, Aspen, their prices have gone through the roof, but these are people of means. But FHA lending is still 3.5% down. So it's, you remember accounting from school, right? Last in, first out. If you think we've got riots in our streets today, wait until the people who are upside down when forbearance for 12 months expires in March. Wait until they realize they're upside down in their houses and get foreclosed on. You got 7% of the mortgage market in forbearance.
Right.
You have a foreclosure moratorium. You have 15% FHA delinquency rates, the highest in records back to 1979. So once banks can start to move on this, people are going to realize that they asininely bought in at the top of the market, of the housing market. But this is created by the Fed.
So that brings me to another subject as far as from an investing standpoint. My assumption would be that you are probably bullish precious metals and maybe like gold, silver. How do you feel about precious metals and what's going to continue to drive those prices higher?
Well, so right now, investors they're going off of the traditional textbook that says, okay, if the Fed's full of it and there is no inflation, then why am I holding gold? And so you've seen that step back. And we're also seeing a miniature repeat of what we saw in March and in April with people going, I've got margin calls, my portfolio's all over the damn map, but at least I've got value, so I'm going to sell my gold. So you've got two different dynamics going on right now. But if you look back through history, gold has outperformed in inflationary and deflationary times as long as there's disruption in the markets. So I'm holding steady on my gold because I think that there's disruption in the markets and more to come with a potentially contested election and volatility out into November. Really, really expensive. What's not expensive is the move. So if you're looking for protection and you don't want to buy equity puts, buy the move.
Got it. Okay.
I try to protect them.
Do you feel the same about cryptocurrencies? Like, what's your opinion on cryptocurrencies? I'm going to tell you personally, I just don't know enough about it, but I know the trading community at large is a fan of cryptocurrencies, is maybe a different type of hedge. How do you feel about that?
Well, I mean, it's kind of like, it's like TikTok for, it's, instead of whatever we had when we were, I'm much older than you, but the Walkman, it's like that. People who remember what the Walkman is, they own gold. And people who want to make a name for themselves, they own Bitcoin because it's hip, it's happening, it's like the new gold, it's a place to be. I mean, I was part of the Bitcoin scam on Twitter, so Bitcoin can put it where the sun doesn't shine. So anything that's penetrable and you can get in there and jack with it, and it can be part of crime and all this other stuff. Now, I'll possibly have a different opinion about it if we go over the line into quantum and it becomes a lot more economical to manufacture this thing because mining is not economical. But really, Bitcoin it's a reflection of people's disgust with fiat currency and the Fed trying to cut your dollar in half in 50 years time. Right. So, but I own gold.
Well, that makes a lot of sense. I know we only have probably about 15 minutes left. I did want to ask you though, a lot of people in our community look at what the Fed's doing and expanding the balance sheet, and we see other central banks are obviously matching that as well. $1.5 billion
every hour.
Say again?
$1.5 billion per hour worldwide.
That is crazy. So
why don't we have a 40,000 Dow?
Right, exactly. So asset prices are going to continue to go higher. Maybe we continue to see everybody's looking at a V-shaped recovery. I see the K-shaped recovery. Am I crazy?
Very K.
I'm sorry?
It's very K.
Okay.
It's extremely K. Because you've got, people are tired of hearing it, but small businesses still employed 47% of Americans prior to COVID. And they've been put out to dry. They've been completely left behind. And that's going to have long-term ramifications. It's going to take a lot of rebuilding efforts. There are going to be great innovations. I don't think I'll ever step into a pediatrician's office again as long as I live, unless the kid's bleeding. So COVID's going to create all kinds of new industries, and that's going to be wonderful. But in the meantime, there's going to be a lot of rebuilding to be done. And I don't know that the K is permanent because we're seeing Raymond James announce 4% of its workforce is being laid off. We're seeing the country's largest law firms make layoff announcements. So if you look on Indeed.com in the latest week, job postings for lower income individuals are down by 12% year over year. Job postings for high income individuals are down 24% year over year. So the K is going to be in trouble if we continue to see this trickle up effect and white collar layoffs, which is a byproduct of demand destruction. It just takes a lot longer to move the pig through the python. The initial people who lost their jobs were low income, and the stimulus replaced it, right? We had the biggest increase in personal income in the history of mankind because of the extra $600 a week. So we've had retail sales really hang in there. But if you start to see white collar layoffs, then the K is in peril.
That makes a lot of sense.
Talking about a W.
So, I was going to ask you, do you ever draw parallels between, and I don't know how much, how much studying you've done on Japan and what the Bank of Japan has done over the last, 20, 30 years, forever, keeping the rates at zero. I know the demographics are different between the U.S. and Japan. It's apples to oranges. But do you see any parallels between Japan's economy and the U.S. economy, and how the BOJ has acted over the last 20, 30 years, and how the Fed is going to be moving forward?
Yes and no. The no is the fact that about a third of treasuries are owned by foreigners.
Right. So
the JGB market is fully domestic, owned internally. So
post office.
Yeah, it's owned by the post office. Yes.
Right, it is.
and the banks own 40% of CLOs.
Right.
And Dan Fuss, the most intelligent, brilliant fixed income manager in the world, is like, I'm not going there. So good luck, Japan. But so they're not beholden to the kindness of strangers. But we're not Japan in the sense that we don't have a long runway in front of us to start the printing presses, because we've already pushed it so far. And we're not at the point where we can begin a recovery. So starting points matter. And it would be more convenient if we could be Japan, because Japan has gone in and out of recession for years. There have been about five recessions in Japan. They're in recession again, obviously. The whole world is in recession. But Japan has gone in and out of recession for years despite their monetary policy. And if you look at the price to earnings ratio, you can't buy multiple. And so the Bank of Japan's been pushing on a string, but nothing cataclysmic has happened to the Japanese economy other than, they've quit being the innovative country. That's now in China. So, and their demographics are a train wreck, but it's more likely. My good buddy, George Goncalves, at Bond Strategist on Twitter, if you don't follow him, do. He's so smart. But he sent out a poll a few weeks ago that said, are we in this scenario, this scenario? He and I both think that we're in Great Financial Crisis 2.0 because of the credit situation.
Wow.
Instead of Japan.
Okay. Well, that brings me actually to a question. This comes from the gentleman who's in our community that saw what you were wearing. He's like, you guys are going to be matchy. His name's Leon. And he said, this is a question for Danielle. He said, is there a way for the Fed to get out of the box it's painted itself into? ZERP forever, and they keep buying every increasing treasury debt. Or if not, what happens to the market on its own, starts raising rates or debasing the dollar index? From her book, Fed Up, and comments since she's not a fan of the Fed. So her thoughts on what the end game would look like would be interesting. Thanks. And that's from Leon, one of our community members.
So, that's the $1 trillion question out there. Right. Can the Fed ever extricate itself? Can the Fed ever exit? And I think that the answer is you just look at what happened in 2018. And, the Russell 2000 and the broader stock indices have not ever gotten back to all-time highs since 2018, when the Fed tried to begin extricating itself. So I think it'll be very, very tenuous at best. Jay Powell in his press conference used the words 7 years. They did it for 7 years last time, and it didn't create a bubble. And I'm like, did he really just say that out loud? But I think that they think that they can do this for 10 years. I don't think the markets are going to allow it. I think that inflation will. Bond vigilantes are not dead. They've just been hibernating for a really long time.
I was going to say they are hibernating then, because there's a lot of, and I'm not going to put. This is at the beginning of our 3-day event, and we have a lot of fund managers and asset managers that are coming on the next couple of days. And I think, and again, I'm not going to put the words into their mouths, but I know there's a few out there that are like, the Fed can continue this much longer than we believe, which is obviously what they want us to believe. But at some point,
continue it. But as long as there's deflation, they'll continue that. But I mean, let's just say Biden wins. I'm not talking politics here, but let's just say Biden wins.
right?
You know, when the debt ceiling was passed, it wasn't because Trump and Nancy decided to play nice in the sandbox. It was because the Democrats negotiated for there to be no ceiling on debt issuance through June of 2021. So you could have stimulus legislation passed the likes of which we've never seen between now and June. But again, at some point, I think that bond investors will hit their pain threshold.
Yeah. Okay. And that's, again, the billion-dollar question is when that's going to be. And I think we're all going to be waiting for that. You know,
Yes.
Danielle, I actually have a couple of fun questions before I let you go, but I just want to say what a pleasure it is to have you here. And before I ask you these last two questions, how do people follow you? Because I just found you on Twitter. I'm actually going to be buying your book, and I'm a super fan of Danielle. So how do we follow?
Subscribe to Quill Intelligence.
There we go.
QuillIntelligence.com.
So you write every day, and you write analysis
every day. And we
Okay.
put out investable ideas for our institutional clients. We publish a huge weekly thought piece. Macro investing is hot again, which is so awesome.
I
Because
know. Make it
data-
macro great again.
the data means something. It's like, wow, the data are relevant, yay! So, but we put out there, like you hear me speaking, is as I write. So it is unvarnished, and it's the best research out there. And if you have insomnia, at DiMartino Booth, follow me on Twitter. I'm everywhere else, but I'm definitely the most active on Twitter.
Well, thank you so much for that. And like I said, I got a couple last questions. This one might be a fun one. Since you were an insider at the Fed, and you've got to know, because we all as traders have this question: is the Plunge Protection Team real at the Treasury?
You know, it is. And I know every tinfoil wearing hat out there is just like, see, I told you so. But it's not inside the Fed. So it involves more than just the Treasury and the Fed.
Yeah.
So it's a bigger animal. But you know, you have to have like Lehman Brothers, something along those lines, because we were limit stop down. Days
Right.
after days after days after days after days, and the PPT was not fired up. But that's because they had the doomsday scenario plan for the credit markets already ready to go on March 23rd.
So there you go, guys. For those of you that need to put your tinfoil hat on, we're all going to put it on soon as we're done with Danielle here. The last question for you. You know, I know you'd mentioned that you just moved to Dallas, and I was, you know, I moved there in '99, and I lived in Uptown before Uptown was cool. So,
Cool. That is cool.
yeah, it was
Go
fun.
there.
Yeah, but you know, my kids, we raised them in McKinney, and you know, we moved north. But it took me 7 years to be a Dallas Cowboys fan.
Oh,
How about you?
I was raised a Houston Oilers fan,
Oh,
which
geez.
means that you grow up hating the Cowboys, and I'm not a huge fan of the Cowboys.
Oh my
I'm a
gosh.
huge fan of Longhorn football, though. And
There
this
we
is
go.
going to be our year. It is going to be our year.
Well, Danielle, I really, really want to thank you for being and really kicking off the Traders Summit. You are an amazing person, and I love hearing your thoughts and ideas. And I know all of us here want to hear more of it. Guys, do you have anything that you want to say to Danielle?
Yes.
Wow.
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 That, I think-
Man, that's all I could say. Wow, man.
I know I hold back too much, right? I'm too
You're so
diplomatic.
introverted, Danielle. You know, and you
Gotta get
really
out
can
more.
you get your energy level up a little bit. What a fantastic interview. I'm jealous Blake did it. Well, great interview. Thank you so much.
Absolutely. My
Steve,
pleasure.
did you have anything you want to say to Danielle?
First of all, thank you very much. It was a wonderful interview. I wish we had more time. Blake, I do think that we need to organize another debate. I would really want to see Mrs. DiMartino with Mark Dow.
Oh, you know,
Do you know Mark Dow, Mr. DiMartino?
Not personally.
But yeah,
He'll be here tomorrow.
Yeah.
he'll be here tomorrow. I spoke with
Keep it my
him
best.
1 hour the other day. I know that your opinions diverge quite a lot. I'm on your side, on the side, on your side of the field. But I
You
think it
never
would
get
be an
over the
interesting.
PTSD if you've worked on the inside ever, unless you're one of them, which I wasn't. So.
Wow. How'd you like to follow this? Anyway, I learned a lot from you today, Danielle. So
Are there any burning questions from the audience?
Others did. Yeah. Anything from the audience? We have a couple minutes.
I think I should read this one. I'm using, Donna says, I'm using Zoom for the very first time. I'm 70 years old, and because of following Danielle for months, I have become interested in economics and have learned so much from her. She's an amazing woman and person, and I so very much appreciate her wisdom and willingness to share with all of us. So thank you. And my question to you is, how have you managed to do all this and at the same time continue to be such a fantastic mom and wife? You're truly an inspiration. Thank you.
It helps to kind of get rid of that notion of sleep being important.
Trader.
That's old fashioned, you know. But we have 9 televisions around our house, and really not enough room for all of them. And the children always know that I'm like this, trying to see Bloomberg behind him. So you just kind of roll with it. It's really a difficult job. I have an amazing team at Quill Intelligence, and it's helpful that I was born with quite a bit of energy. But you made my day, because you're 70 years old and you're on Zoom, and I love that. Fantastic.
A lot more comments I could read, but I think it was the more indicative of the love people have for you here.
Yeah.
That's awesome.
Yeah. You're planting great seeds, Danielle. And no one's going to be surprised that follows you what might happen. So you're also kind of a watchman for all of us. And we appreciate that.
Well, I can't do anything else. So I'm one of these lucky people who got to grow up and do what she really wanted. And that's a gift.
It is.
It is indeed.
Well, thank you once again, Danielle, for spending your time with us. We really appreciate it. And we'll see you on the next debate in a couple months.
Sounds great. Look forward to it. Thank you,
All right,
gentlemen.
thank you.
Take care.
Have a wonderful rest of the day.
You too. Okay. Bye-bye.
Bye-bye, Danielle.
That was amazing.
That was great. Good job, Blake.
I had fun. I had so much fun doing it. I could have done that for another couple hours, but I know we are jam-packed with more going